And we are live. How's it going, friends and family? My name is Amos, and in this video, we're going to be talking about the stocks that are reporting their earnings this week. To keep you in the loop, earnings is essentially when a publicly traded company gives you guidance going forward of how their operations, what tailwinds and headwinds they're looking at, but also in the past 90 days, how things have been going. And in my experience in the stock market for the past 7 years, it's usually when the opportunities to buy a company arises, because that's when Wall Street hedge funds and other investors, they emotionally overreact. So if they say something that makes them really nervous, the next day you literally might see the stock go down 10, 20, 30%. For me, I've always looked at it as kind of like an opportunity or a gift from the market to jump in. For the inevitable rebound, especially if it's a high quality company. But if it's not, it's low quality, they're burning cash, and they suck, obviously I'm not going to jump in. But anyways, it's also a good time to stay up to date with the companies that you are eyeballing. If they're on your watch list and you're contemplating jumping in or not, really good time to figure out and to cement the idea of like, hey, I think this is the time to do it. Or if they're in your portfolio, dude, it would behoove of you to stay up to date to how your business is doing, right? You are a share owner, which means you're a part owner of the business operation. But anyways, can you believe that we're already in February, the second month in 2026? It's kind of a weird feeling, right? But I just want time to slow down a bit, okay? Because I'm only getting older and older, and it's kind of terrifying, right? But on the bright side, hey, we've got the Super Bowl this weekend, Seahawks versus the Patriots. I get it. Not all of you are fans of American football, but dude, sign me up. It's the little things like that in life that give my, day-to-day a little spice. I'm super excited. Obviously, I support the Seahawks. My camera's off, but I've got a huge Seahawks banner on the backdrop. And what I'm trying to say is this time, I hope that they choose to run the ball if we're on the 1 yard line instead of passing it. Because this is a repeat for the 2015 Super Bowl. Dude, I was so pissed off when they made the executive call to freaking pass the ball on the 1 yard line, especially when we had Marshawn Lynch, which at the time, pound for pound, the best running back. And you're not going to give him the ball? I don't know. Anyways, outside of investing, you got to have a hobby or two to keep life interesting. But circling back, I'm so sorry. What are we seeing? What are the themes, the highlights, call outs before we dive deep into each day of the week? Obviously, it's Tuesday. I apologize. But anyways, a continuation from last week. We have the other Mag 7 reporting. We got Alphabet. Can we just refer to them as Google at this point? We've also have Amazon. Last week, Tesla reported, they said, hey, we're going to stop production of the X and the S model for their EV line, which is kind of hilarious. They're making the huge pivot to going straight into making robots. I think it's called Optimus. And to be honest with you, it's such an Elon Musk kind of a thing, okay? That kind of transition. Microsoft and Meta also reported, and I thought they both crushed, right? But Meta spiked in their valuation, whereas Microsoft, continuing on this week, they're selling off. And that's because they have a bunch of their capital tied up with OpenAI, especially with their RPO, their backlog of revenue to be earned. And I think the market's just really spooked of how much money is, I guess, in a circle going in and out of OpenAI. And we don't even know what kind of profitability issues that they're running into. And as of right now, we do know that they're highly leveraged, and we don't know if their game plan's going to map out. But what we do know is that later on this year, OpenAI should be IPOing. So that should be kind of exciting. But anyways, with the Mag 7, obviously, what you want to be mindful of is the guidance going forward. It doesn't matter what they did in the past 90 days. From my experience, all they care about is what is going to happen in the future. So that's what makes the Mag 7 move up and down, especially the return on investment from CapEx spending. I think that's going to be the most critical and crucial, because I think for the longest time, when I say longest time, I mean like 2 to 3 years, I think the market's they bought in, right, to the vision, to the game plan of like, hey, we're spending 50, 60, $100 billion in CapEx right now. That way in the future, the fruits that will be harvested, it's going to be super delicious and juicy. And I think the markets are now waking up and realizing, hold on, I feel like you're just playing us now, smokes and mirrors. What's the actual tangible results? And the margin increases, like what's actually happening from the CapEx? Are we seeing any ROI? And I think that's a good thing, right? Because for the longest time, I don't like when companies move on just hype and narrative. I want to see the numbers and the financials moving in the correct direction. And that makes sense, right? If you're going to be spending billions of dollars on the so-called, AI bubble movement, right? With the hardware, the data centers, you want to see higher margins, higher revenue, and capitalizing on the cloud growth. So, yeah. Anyways, last week, I'm really glad that Microsoft went deep into the red because lo and behold, I actually jumped in, picked up one share. I'm going to continue to pick up a share or two throughout this week. So, yeah. What else do we have? Obviously, if you take a look at your screen right now, the big pharma companies are reporting. We got Merck, we got Pfizer, we got Eli Lilly, Novo Nordisk, and Eli Lilly, dude, they've been crushing it with the weight loss drugs. As of right now, they're the market leader, and based on my market research, I uploaded a video about the pharmaceuticals 3 weeks ago, whatever. They should have about 50% of the TAM, the total addressable market, when it comes to the weight loss drugs. So they're killing it, right? And what's also funny is that about 50% of their revenue comes from that segment. So their tailwind, if you want to look up their stock price performance in the past 5 years, it is ridiculous. I would argue it probably outperforms most of the AI stocks. But hey, their success has been the key culprit and reason as to why the food stocks have been hurting. Because now that all the fatties are getting skinny, they're not eating as much, right? Because you don't have that craving to pick up a bag of chips, to eat candy, to eat, junk food in general. So it's kind of interesting to see the dynamic, right? But also it's a good thing, right? People are getting healthy by not feeding themselves to getting, what is that called? Is it diabetes? Right, you can eat your way to diabetes, right? From my understanding. Other than that, there's also a crap ton of blue chip household names like PepsiCo, Reddit, Toyota, AMD, and Uber. Speaking of which, if you've been eyeballing Uber, hey, this might be the week for you to jump in, depending on how things go, right? And let's see, since we skipped Monday, Palantir just reported. I finished tuning in to their earnings call, and dude, it was so spectacular, and that's why their stock price is ripping. I think leading up to the earnings, there was a lot of fear and uncertainty around the company. They were selling off day after day, and I mean it, right? Their stock price was down 20% into the red this year. But after they reported, dude, their stock price is going right back up to 160, 170. Easily. Their revenue, which is their gross sales, it was up 70% year over year. Dude, that's insane. Just absolutely ridiculous. And so they even raised their full year guidance, their commercial revenue, their US government contract revenue. Dude, here's the thing. We could sit here all day long and talk about whether or not Palantir is an ethical company. But I think one thing we can all agree upon is their valuation is fat, and it's fat for a reason. The trading multiple, it's not unusual to see it hover between 350 to 600. Personally, as a value investor, I do not feel comfortable jumping into a business operation with a 600 PE ratio. But if you're invested into them, good job. Honestly, I would shake your hand, because Palantir is the type of company that in the past 5 years would have easily 5x'd your money. So it's good stuff. And take a look at to the left side of your screen. Who else reported? Disney also reported, right? I also thought it was pretty amazing by all regards. Keep in mind, this is a very giant behemoth of a business operation. and they crushed across the board, right? But their stock price, it's selling off like there's no tomorrow, as if they're a dumpster fire, cash burning piece of crap. And that's because the leadership transition plan that they laid out, dude, Wall Street's not buying it, right? And I think it's because Disney's trying to move on from Bob Iger because he wants to move on, but big money, they obviously want him to stay. And here's my thing, okay? I'm sure Bob at this point, dude, he's 74 years old. Okay, keep that in mind. He just wants to retire in peace, right? Kick it back, going on a carnival cruise, drinking some pina coladas, just having a good time. Just wants to take it easy. And the fact that they're trying to force him to stay, like, no, you're not going to let him be the CEO for another year? Okay, we're going to punish your stock. It's freaking ridiculous. Other than that, I didn't have a chance to follow up with how CSWC did. This is one of the more high-quality BDCs, business development companies. From my understanding, they're selling off. That's because the interest rates are coming down. Last year, when there was rumors of the interest rates finally heading towards the direction of being cut, I sold out of all of my BDCs before the landslide. But as the interest rates get cut, one or two things are going to happen, right? On one hand, it's going to be priced in and they're going to rebound in valuation. Or once the interest rates get cut down to like 3%, 2.5%, or 2%, they're going to sell off beyond belief. So for me, BDCs are something that, on the back of my mind, it's a buy and hold for sure, right? But it's also contingent upon the interest rate. So I'm not really interested in buying into them while the interest rates are still pretty high because, there's a lot of uncertainty with how the markets are going to behave. But having said that, let's jump into each day of the week and look at some of these companies more thoroughly. If that sounds good with you, let's go ahead and get into it. All right, maybe we could do a quick little recap and take a look at some of the companies on Monday that reported. Obviously, by the time you watch this video, it'll be Tuesday for you. But for me, it's already 1 p.m. Tuesday here in Japan. By the way, did y'all hear about the trade deal between the U.S. and India? Apparently, the U.S., we're going to be lowering tariffs on all Indian imports because India has agreed to stop buying Russian oil. So if you're bullish about India and you're invested into any Indian stocks, it should be soaring off of that news alone. But for a Monday, I feel like there's a lot of heavy hitters here, right? Palantir, Disney, Simon Property Group. I mean, this is the REIT that's responsible for all of the bougie, nice malls and outlets in America. To be honest with you, it's nice, but it's not my cup of tea in terms of REITs. We also have Tyson Foods. I think they're like the second or the third biggest poultry meat producer in the world. I think number one is this company from Brazil. I always forget the name, right? Because I'm an American, so I don't really follow the Brazilian markets. The only company that I truly care about that is prominent in Brazil is Mercado Libre, and then obviously Nubank, which is ticker symbol NU. We've got Dividend. They make a lot of medical devices for kidney stuff. Very important. Dude, one industry that I'm pretty bullish on, medical devices. So when we talk about like Edwards Life Sciences, Dividend, it's an industry that's... Here's the thing. I think AI is going to disrupt a lot of sectors and landscapes, right? But when it comes to replacing your heart, when it comes to replacing something in your body or like a tube or something, AI can only optimize it and make it better, right? So I'm kind of bullish on medical devices. Hess reported. I wonder how things went for them. I'd have to circle back and look into it. I just uploaded a deep dive video talking about them, and I think the conclusion that I reached, pretty solid company, but not one that I want to invest in, because obviously I'm a dividend growth investor. In that, I want to see the share price appreciation, not just the dividend payout be growing year over year? I think I need both, right? And that manifests in the CAGR. But if I were retired or eyeballing retirement in the next year to two, I would have Hess in my portfolio, hands down. No questions asked. You should go watch that deep dive, by the way. It was a 2-for-1 special because I also did a portfolio roast for the first 50 minutes, and then I analyzed Hess for the last 23 minutes. But other than that, these are all small cap, dingy, random companies I've never heard of. Yeah, let's jump on over to Tuesday and pick it up with reality of what today is. By the way, how's your day going? Is it going well? Is it going rough? Did you lose your temper, road rage, and traffic? Come on, man, you're better than that. But anyways, through this video, hopefully you can take your mind off of things for a little bit, right? A little bit of a distraction. Dang, dude. Tuesday, when you guys wake up, there's a lot of nice companies that are reporting. I mean, we got AMD front and center, right? The main competitor and threat to NVIDIA's throne. But dude, their performance has just been spectacular, right? 112% into the green. I will never forget people calling me delusional, stupid, I don't know what I'm doing, when I made video after video talking about how AMD was undervalued at the end of 2024, heading into 2025. And I was like, dude, this is an easy opportunity to 2x your money. I'll never forget those comments. And I think it really taught me the value and the lesson of believing in yourself. If your calculation and analysis of a company is tight, and it's, airtight, meaning the market has it wrong because of X, Y, and Z, and you were able to prove why they're wrong, it taught me that I need to stick to my guns and have more confidence. Because I put in, I think a couple $1,000s into it, and then I put all of my capital into Google instead, which I still think was the right decision. But when it comes to the confidence thing, right? Whenever I do a deep dive and a research and I analyze a company, it pains me that I only buy 5 or 10 shares when I should go big, right? So yeah, AMD, whenever I look at them, it gives me a confidence booster to know actually, you're not as bad as you think. Because I always have this weird mentality of thinking I'm a piece of crap. I'm a loser, that I'm wrong, that I don't know what I'm talking about. And it's really toxic, right? So if that's you listening to this, you got to think more highly of yourself. Give credit to where credit is due and refer to your resume, right? That undeniable proof that says you are who you say you are. And as a guy that looks at the stock market every single day for at least 8 to 10 hours a day, right? Yeah, man, AMD. When I think about all of the businesses that I made bullish videos for last year, AMD, NVIDIA, Microsoft, Google, military stocks, dude, they smacked hard, right? They all crushed. I think where I fell short was the food stocks, right? I did not anticipate their landscape getting absolutely destroyed. But if you were to have a hypothetical portfolio with equal weighting into everything, I think I would still be in the green by a significant margin, despite the food stocks hurting the overall performance. I put my money where my mouth is. I did invest in the food stocks last year, and then I sold out of all of them at a loss. Dude, it sucked having to do that, right? At this point, the only food stock that I still have in my portfolio is PepsiCo. But it's not a company that I plan on holding much longer. Just a heads up. Speak of the guy right here, they're reporting their earnings this week. Out of the food CPG stocks, I feel like they're probably one of the best. It's just I do not feel bullish about the landscape of their future anymore. And so my investing thesis behind them has completely changed, right? Shout out to Eli Lilly. Shout out to Novo Nordisk. The weight loss drugs, this current admin's war on food, and how there's several jurisdictions and states that are suing the food companies for causing health issues. Just there's a whole plethora of reasons of why my investing thesis is not true anymore when it comes to the food stocks. And so, yeah, it's been crazy. All in the matter of 1 year, so much has changed. But anyways, you got AMZN, Pfizer, Eaton, Chubb. This is probably one of the more high quality insurance stocks based on my fuzzy memory right now. I think it was like an A or B plus out of the entire industry, which is pretty good, right? Illinois, Tollworks, Mondelez. They should be reporting a good earnings, in my opinion, because the price of coca is now back to where it was pre-pandemic. Because during the pandemic, there was coca, the raw ingredient needed to make chocolate products. Dude, it was at an all-time high. So the margin was probably squeezed beyond belief. So for that, they should be doing okay. But again, I'm not interested in them because it's a food. In this case, candy. Right? And they make snacks. So I definitely do not want to invest into them. And I see a lot of oil stocks right here. Oh my goodness. Chipotle. How about we talk about Chipotle? My goodness, have they fallen so hard. I mean, their trading multiple was still pretty fat. So I wouldn't say they're undervalued. But for a company that's executing the numbers that they're executing, it is kind of sad to see how they're falling off a cliff. For Chipotle, I think what matters the most is the metric known as the same restaurant sales growth. Because they open up new locations every year, this number right here, the gross sales, it's always going to go up, right? If there's more restaurants, you're going to make more money. So you have to look between the lines and try to figure out, is each restaurant that's already open, is it making more money? What's the year-over-year change? So in other words, the transaction growth at each operating location. And I think stockanalysis.com, by the way, I have a referral link down below in the description. I think they show us that, right? Yes. Let's see, transactions increase. So it'll show us over here, and this one will be updated once they report tomorrow. I mean, that's good right there, right? 2022 was a 0.9% increase, and then it was 5%, 5%. So if they can continue that 5 or 6% increase, that would be really good. That means more people are buying more quantity of burritos. Because what you don't want to see is people buying less burritos, but their revenue is still going up because the price increased. That, I'm calling it right now, the market will punish Chipotle all the way down to like $31, $32 a share if that is the case. Maybe it's over here in the metrics tab. And yikers. So for the past 2 quarters, can you see? At their peak, December 2024, that quarter, each restaurant, they made $3.2 million in gross sales, but it's been decreasing year over year, and I think that explains the sell-off. So that's what I'm saying, right? If you only look at this right here, the gross sales, and you're like, why are they selling off? I don't get it. Go to the metrics tab and take a look at how each restaurant is performing. It's going down in terms of the money that they're generating. So that's what you want to be mindful of. Dude, I like Chipotle. I'll be honest. I bought into them a while ago and I sold out of them. I paper-handed it, right? I think I only held on to them for like a week or two. I forgot what the logic was. It was like 8 or 9 months ago. But definitely a company that I do want to jump back into. So please don't get mad at me. But for selfish reasons, I kind of wish they do go on a sell-off this week. That way I can buy back in. But if not, whatever, right? There's so many companies out here that it's not make or break with just Chipotle. But who else can we talk about? We were at Chipotle right here, Electronic Arts. That's a video game company that I'm not too bullish about. We're going to be talking about another video game company later on, Roblox. I'm super bullish about the video game industry, not because I like video games myself, but in the age of AI and all the industries getting disrupted, human behavior, right? You always have to boil it down to like the Maslow's hierarchy of needs. Honestly, I'm the most bullish about the bottom, the biggest base, right? Your physiological needs, your food, your water, your shelter, that stuff is always going to be there, right? Without that, you can't survive. And so that's why that was one of my primary investing, tenets of why I bought into the food stocks. But obviously, the landscape has now changed. But anyways, I think the tier right above it is like the stuff that we do for fun, the stuff that we do that gives our life color. So, video games, right? And I feel like Minecraft, parent company is Microsoft, Roblox. Those are two video game landscapes that aren't very small or a niche of just like Roman soldiers fighting one another. Those are the two biggest video game, enterprises that kids, teenagers, and adults all love to play on, and they spend a crap ton of money on. And so as we go forward in the future, as more and more people adopt video games and playing in it, because think about it like this, right? The other day, I was scrolling on my phone and I found out that on Roblox, there's even a Roblox church where a bunch of kids and teenagers go to service on a Sunday because on Roblox, it's kind of like World of Warcraft, where you basically have a character that's you in this universe, which is Roblox, and you can do anything there. There's people that even protest in there. There's people that have church services or crying out loud. So you'll see like a church pew filled with like 500 different kids with their own little character because you are that character. And then there'll be someone that's giving a sermon through. So all I'm trying to say is Roblox is kind of like the metaverse that Zuckerberg was trying to execute on, but it already exists in Roblox, right? So for me, when I think about video games, I'm super bullish. But the reason why I'm not bullish about Electronic Arts, take a look at this, right? Their revenue situation, up and down, up and down, up and down, up and down. It's really inconsistent, and they're more of a company that makes the titles for like the NBA, the NFL, like sporting games, right? And I feel like once you boil your industry to a specific niche, the total addressable market dramatically reduces, right? Whereas with like Minecraft and Roblox, if you have kids right now, go ask them how they feel about Minecraft or Roblox. You will quickly realize it's just a game, and the universe is endless. Like you can do anything in both of the games. There is no niche. Do you know what I'm saying? So anyways, oh my goodness gracious. We also have PayPal reporting their earnings. Now, here's the thing. When it comes to PayPal, I scratch my head. Because when you take a look at their financials and fundamentals, they are so sound. This is 2015, right? Their bottom line per share was $1. In past 12 months, it's just shy of being $5. And I'm saying it right now. This is only going to get better because they're buying back their shares like there's no tomorrow, right? If you take a look at the shares outstanding situation, I'm telling you right now, this is probably one of the best fundamentally sound companies out there, but it's their future that the market feels uncertain about, right? Past 5 years, negative 78%. Past 1 year, negative 40% into the red. Trading multiple on 9.4. With the numbers that they're executing, you take a look at their books, they have $10 billion of cash on hand. Take a look at their total debt, $12 billion, and you might be like, that's too much, and that's why you look at whether or not the loan obligations are sustainable. The debt to EBITDA says 1.8. It would take them roughly 1 year and 10 months to pay off all of the loans on the books using their own core operating profits, which means their debt situation is not bad at all. The golden standard is 3 or less. To see a 1.8, sign me up, right? And they even have a dividend. But friends and family, when it comes to PayPal, I think the metric that nobody talks about that's really important, that's also really concerning, is their transaction take rate. So for each transaction, how much money does PayPal take home, right? And it should be right here. Transaction take rate, year over year, they're getting less and less money from each transfer, from each processing, from each whatever. You want to see the complete opposite trend for a payment processing, payment transfer software enterprise, right? If this number goes down, I'm saying it right now, PayPal is going to go $45, $44, $43 a share. The fact that they can't find a way to stabilize or increase their transaction take rate, that's their issue. Does that make sense? And also, it's not just PayPal, right? If you look at all of their competition, everybody that's in the industry of processing payments, they're all deep in the red. Even Visa, even MasterCard, right? You telling me right now that Visa for the past 1 year is negative 2.3%? That's exactly what I'm showing you, right? And I think that's because there's a lot of speculation that the payment processing landscape is about to be radically and fundamentally changed in the next 5 to 10 years. Reason being is that I think a lot of merchants and small business owners, I think they're getting fed up with these toll booth monopolies, or I guess duopolies, because there's also MasterCard. These companies taking 1, 2, 3% of each transaction, right? And they're like, why do we have to keep paying them money when we can, directly transfer money from the consumer to us? And if that is the case, we could charge less for the menu items as well. And I think that makes a lot of sense. But then again, you're also, what's their performance in the past 1 year? Flat. But then again, when you think about it, they're not just taking a cut to help transfer the money into your account. You're also paying for fraud protection, for the money network to work as intended. And if there's any problems, MasterCard and Visa deals with it. You don't have to deal with it, right? For scams and whatnot. Then again, what I am hearing is that in Brazil, I think it's Brazil, it's one of the big South American countries, Latin America, there is a government-sponsored finance payment processing QR code thing where you can transfer funds between merchant to consumer, a consumer to a food stall or a food truck, 0 transaction fees. So if you pay $100, the merchant or business owner gets all $100. And in China, almost all of the transactions are done through a QR code, where it goes from your account directly to the vendor or restaurant owner's account with 0 transaction fees as well. So what I am saying is, I think the Western world, especially North America, Canada, the US, Mexico, and especially Europe, we're realizing that there's ways to get around from paying MasterCard, Visa, PayPal, Square, and them taking a chunk of the cut. So if you cut out the middleman, the merchants obviously win, right? For the consumers, though, they don't really see a tangible benefit. So I think what's going to happen, now obviously I'm talking out of my butt, but I think what's going to happen is I think Visa, MasterCard, PayPal, they're going to have to intensify and obviously incentivize the consumers to continue using their cards or their payment processing modality, like more cash back, more rewards, more of whatever, so that the free payment transferings never take root. Because once that is fully adopted and people start buying in, dude, MasterCard, Visa, absolutely going to be cooked, right? And you might talk about, well, then who's going to do the debit and the credit cards? Unpopular opinion, but I'm going to go ahead and assume it's going to be directly linked to your bank or to your Apple Pay, Google Pay, Samsung Pay. So I think out of the whole fintech payment processing landscape, I think the winners here, this is going to sound really crazy, I think it's going to be big tech. Okay? But circling back to freaking PayPal, see, Visa and MasterCard, they're not a financial bank, correct? They only help process cash and to help the cash get to the right place. PayPal, on the other hand, that's only one thing that they do, right? When you think about PayPal, they do almost everything in the financial landscape, even processing payments for OpenAI, right? They even have their own credit card. They have their own everything. The only thing they don't have yet is a digital online bank. So what I'm suggesting and insinuating, if they make the right pivot and the right step towards becoming an online bank, I am calling it right now. I'm not a genie in a bottle with a big dong, but once they start looking more and more like SoFi, I'm telling you right now, PayPal's going to start seeing their valuation rebound and start to see numbers like SoFi, a trading multiple around 30, around a 40. If PayPal continues to stay stubborn, just like this company right here, Western Union, of no, we're only going to stay in the business of transferring cash. It's like, dude, you're going to see trading multiples of a 4 or a 5. You need to make a fundamentally coherent business strategy to stay relevant, right? Western Union is probably one of the worst business leaderships that I have witnessed. How can you let your business fall like this year over year and not be proactive? Now, obviously, in the past 6 months, they have now decided to have an app to do digital and online transferring, whereas before they doubled down and they were like, no, we're only going to do physical cash transference for our underserved community living in the U.S. that are undocumented so that they can send money back to Peru or Honduras. Dude, absolutely, like, what are you thinking, right? Now they're too late, in my opinion. Likewise, I remember in 2020, I tuned into an earnings call for AMC, which is a movie theater company. And I remember one of the analysts, they were like, listen, the trend that we're seeing is people want to be able to pay and watch a movie in the comforts of their own home. Do you have any plans to make AMC not only a movie theater where you walk into in a physical location, but also an on-demand service or digital streaming service? And I remember the CEO at the time, he's like, I think he's a Harvard-educated guy, by the way, which means don't ever look at someone's educational background to decide whether or not they're smart. He was like, no, we were not going to move any of our content or divide the business's attention into going into online streaming. We don't see online streaming panning out. We just think it's a fad, a trend, and it's going to go away soon. Dude, can I just pull up AMC and show you what is that? I remember walking away from that call thinking, I will never put my money into this stupid company. Had he have just made that transition into the streaming wars back in 2020, things would look a lot different, right? To be $1.40 a share, I mean, come on. I feel like it doesn't take a fortune cookie from San Francisco to know that your industry was going to be absolutely disrupted and to double down and say, no, we're only going to do physical movie theaters while your movie theaters were closed because of the mandate of not being allowed to go out. How stupid do you have to be to say, no, we're not going to do any online digital content? Now, obviously, did I say 5 years? It's 2026. So obviously it's been 6 years. So I don't know, right? Maybe AMC does have an app. They do have a streaming platform. I don't know. But what I do know is 6 years ago, they doubled down and said, no, we're never going to go in that direction. We think it's stupid. And I remember like, dude, you guys are cooked. And, you know, it's been like 6 years since I took a look at what happened to them since then. I'm so glad I did not go near this company. What a terrible call, right? And I know some of you might be like, dude, you're so mean. Hindsight is 2020. Nah, dude, just think logically and with a rational perspective. If you are a physical movie theater operator heading into 2020, 2021, understanding that people cannot go to your business establishment to spend money on the concessions for popcorn that costs $20, how are you going to make money? That was the perfect opportunity for them to jump into the streaming wars to open up a Netflix type of streaming service, and they could have been crushing it. Listen, I'm an idiot, okay, but my background's in strategy. So I'm a guy that understands not only do you have to be crushing it at what you're doing today, you have to be 5 steps forward thinking about what's next. How can we stay relevant? How can we increase our economic moat? AMC, perfect example of a company that just got caught with their pants down on their ankles, and it's a tiny, tiny little thing there, right? And it's like, dude, and that's why I think big money punishing Bob Iger, I think I understand. The leadership that's steering the ship of a company is so freaking important. And I think that's why Warren Buffett said he likes to buy into companies that do not rely on a charismatic leader like Elon Musk or a founder-led leader, because once they are removed from the situation, the ship can sink. Right? So he would rather invest into a business operation that even an idiot can run. That way, he knows in the future when an idiot does run the business, it'll still be smooth as, I don't know, a bald 50-year-old man's head, right? Very smooth. But I think that makes a lot of sense, right? And that's why he put his money where his mouth is. He invested into the insurance business. It doesn't really matter who the CEO is. By the way, 2 weeks ago, AIG went on a massive sell-off because the CEO was like, dude, I want to retire. And it's like, dude, the insurance industry, even without the C-suite, they would still crush, right? And that's why Warren Buffett also put his money into Coca-Cola. It doesn't matter who's the CEO. It doesn't matter who the CFO is. You're in the business of making soda. So easy, right? So I don't know. I guess that was a really good reminder of that lesson of avoiding companies that live or die by their CEO. Because once the CEO is caught, making out with the chief HR officer, or if they say something racist on their Instagram account, then the entire stock gets crushed. But yeah, let's circle back to freaking Tuesday. I cannot believe we're 40 minutes in and we're still on Tuesday. I'm so sorry, guys. But looks like we also have Prudential Financial. We also have ADM. Gosh, I'm trying to see if there's any that's worth our attention. Okay, there we go. Super Microcomputer. This is a very interesting one. They're basically in the business of making the data center server racks, where all the chips and stuff are put together. They're the ones who assemble it. And if you take a look at what's happening to their stock price, a very volatile company, okay? There's highs and lows, but for the past 5 years, it's 800% into the green. And they are on my watch list, but I'm very scared to go near them. Reason being is their recent sell-off, it's because they got caught cooking the books. Okay, so their accounting and what they've been reporting, it's not aligning. Okay, and they're also losing the battle right now to Dell and HP for making the server racks. But if you take a look at their numbers, I mean, it is kind of crazy to see, right? And I think this is kind of the same territory and ball game as what's happening with the SSD players like Seagate, Micron. Because for data centers to operate, you obviously need memory. So SMCI is complete opposite end of that. If you want data centers to be up and running, you need the hardware and the server racks to be assembled. Here's the thing. I'll tune in to their freaking earnings because it's one of those things where as long as the data center movement keeps thriving and keeps flourishing, I feel like SMCI has so much potential, but with the whole accounting fraud probing that's happening, they also have the potential to go down to like $10 a share, right? It's like high risk, high reward. And it's just one of those things where I'm like, do I really want to go near them? I don't know. Hold on. Is there anything else on Tuesday? Moeller, Ball Corporation. Dude, Gartner. Dude, they're getting so hammered. Can we just talk about them real quick? It's a consulting company that usually gives you like market insights or like high level stuff that you could easily Google. I truly do not understand how are they still in business, especially in the age of Google, especially in the age of AI. This is a company where I would not want to go near. Trading multiple 15, I think that's way too fat. Oh, we have Clorox. Funny enough, I'm invested into two consumer CPG companies. Clorox is one of them. I honestly think it's a buy and hold. Let's take a look at their total stock market performance, 39,000% into the green. I mean, the stuff that they operate and they do, it's here to stay. It's here tomorrow. You could sleep well at night. Obviously, it's not a 10x type of investment. But, yeah. Oh, wow. Skyworks Solutions is reporting. They're in the business of making RF chips related to 5G. And I feel like 70% of their revenue was tied up with iPhones. And then iPhone decided to make their own chips. So this is a company where if you take a look at their financials, it's getting hammered. So they're trying to stay relevant by making chips for other stuff, other industries. Personally, out of the semiconductor chip space, this is one that I would not want to go near. I feel like their future looks really, really dark. I'm not even trying to be a bear, but that's the thing. When 50 or 60 or 80% of your revenue comes from one client and they decide to jump ship or go to your competitor, you're screwed. And I think that's one of the reasons why Microsoft got punished really harshly, because they have so much capital put into OpenAI being fruitful. But if anything happens to OpenAI, then Microsoft's going to be screwed, right? And I think that's why Oracle's getting the same treatment too. Maybe we can take a look at Oracle as I talk about it. Oracle is basically, they're trying to be the infrastructure that supports OpenAI, and they're pivoting into becoming a data center company for OpenAI. So imagine that, right? And that's why they're selling off very harshly. Because, I don't know, guys. OpenAI, I think it's a very controversial take right now. Because I think like 4 years ago, best in class, right? When it comes to the AI, LLM movement. But now we're quickly realizing they're no longer the biggest dong in the gym locker room. We've also got Google's Gemini. You also got Microsoft Copilot. You got Anthropic's Claude. They have so much competition that OpenAI is no longer the most handsome, most beautiful business in that space. And as their economic moat continues to erode, these companies that are putting $100 billion into them, you see what I'm saying? And that's why I can kind of agree with why Oracle's selling off, but I still can't agree with why Microsoft's selling off. Because despite the OpenAI partnership, I feel like OpenAI's entire earnings was super beautiful. I mean, obviously the Azure, the growth is kind of slowing down, but it's still, can we pull up Microsoft? Do I have your permission, or are you going to call me a racist? Let's pull up Microsoft and take a look at, I wonder if it's going to be right here. Revenue by segments. Take a look at the Azure section, Intelligent Cloud, 120 billion. So like, I guess what they're wanting to see is that number be aggressively growing, going from 113 billion to 120. I guess it wasn't good enough, which boggles my mind. It's like, dude, how much more does it need to go? You know what I mean? Like an increase of 25%, which is better than the previous like 5 quarters. 23%, 22%, 21%. It wasn't good enough. And that's what boggles my mind. And it's not even a company like Palantir where their trading multiple is outrageous. Microsoft's forward trading multiple is a 24. And to be punished this harshly, negative 12% year to date, kind of boggles my mind, right? Can we just pull up Palantir and look at their trading multiple to put it into perspective? Oh, wow, the PE ratio is 240. Not too bad. I mean, 234. But obviously, when it opens up tomorrow at 160, 165, it's going to jump right back up to like 300-ish. So, I don't know, guys. We have Match Group. I'm pretty sure this is the parent company of all those online dating apps. But what we are seeing, I read an article, I think it was from the Wall Street Journal or The Economist not too long ago, and it talks about how folks are now gravitating away from Tinder, Grindr, and all these dating apps, and now they're trying to meet people organically, in person. And that's one of my bare statements for Duolingo, right? I think we're learning as a society, we are missing that human interaction, right? And that's what I said, that more folks are going to realize you're not learning crap with Duolingo. So eventually you're going to put your butt into a seat, into a classroom format, and try to learn the traditional way. That way they can correct you on the spot. You can interact with the partner to your left or right. Likewise, with these dating apps, I think my demographic, the millennials, the people that are like 30 to about 50 years old, I think it was a huge success. But I think for the younger generation, and especially the older generation, the ones that are like divorced at age 60, dude, at that point, you might as well just stay till the end. What's the point of divorcing someone after being married for like 40 years at age 69? That always cracks me up. It's like, dude, y'all made it this far. You might as well just see it till the end, right? Well, I don't know. I guess the other school of thought is, no, I've already put up with his saggy nutsack for 40 years. I can't deal with it for another week. Besides, I just want to be happy. I get that. But anyways, all that to say, with dating apps, I feel kind of bearish because I think the numbers prove that they're losing steam, right? It's flat now. You would think it would be increasing and growing, but in a day and age where all of us are more secluded from one another and everything's becoming more and more online, I think we're missing the sense of community, fellowship, having people, physical interactions with people. So I'm not trying to throw ideas out there, but the other day, like 3 months ago, I was thinking like, what if I were to start like a in-person speed dating kind of a business operation that pop shops in popular cities like in Chicago, Detroit, Houston, to allow organic interactions with people, and then to buy a ticket. That way there's like a vetting process to make sure that everybody that's there is a solid eligible candidate, right? No crazies, no weirdos, no catfishing. Everybody has to pay to get there. That way the person that's sitting across from you is serious about it as well. Just a fun idea that I had. And then I was like, dude, I feel like the logistics of running that would be really fun. But I guess one of you guys can steal my ideas if you want. And I'd be more than happy to be a part of the board to help you raise capital, to help you grow. But yeah, very bearish about this company. Likewise, if we take a look at their counterpart on the other end of the like Grindr, which is meant for the LGBTQ community, also seeing the exact same, well, not in their numbers, but in their valuation also getting crushed. So maybe that community prefers to meet online, whereas I guess the normal orientation folks, not so much. I don't know. Anyways, let's move on. Anything here that sticks out? H&R Blog. This is a company that I've been watching quietly, not with too much attention, not with too much emphasis, because it's the company that does tax returns. You know, like when you go to Walmart or a Target or like a shopping mall, you'll see their little kiosk saying, hey, we'll help you do your tax returns. So they rely on a crap ton of people to help process 4,300 folks. And there's even more that are 1099 that are not categorized as employees. But I feel like this is a company that AI can absolutely propel and help, not eradicate, right? And the reason why I started looking into them was because of Intuit as well. Intuit does the exact same thing with the QuickBooks, TurboTax, and everything. So they're on the other side of that spectrum where it's not human representatives helping people, but whereas they sell the software, and H&R Block is the exact opposite problem. They have people that are CPA certified, handling taxes for a family that makes like 30 grand a year at a Walmart, of all places. But imagine if they were to, I guess, pivot from using humans and using more of like a kiosk that's a touch screen, and they can just do all of your taxes right there on the spot, right? That's what I think. But again, I'm kind of scared to go near them because they're selling off like there's no tomorrow, right? But for the past 5 years, they're still 100% into the green. So this is a company that I'm quietly going to watch, but I cannot recommend anyone else to watch them because their business model, it's hard to say that I'm bullish about, right? The dividend profile is really cute, though. A 14% dividend growth rate, 35% payout ratio, 4% dividend yield. Dividend profile checks out, but it's one that I'm going to watch, but I probably won't follow up on because, yeah, it's H&R Block, guys. It's not Intuit. Anything else in the billion-dollar market cap category? No. I guess we can move on to the next day, which is Wednesday. And then, yeah, we have the Mag 7, Google. We have Eli Lilly. I think I already told you guys about them. Oh, yeah, another pharmaceutical, AbbVie. Novo Nordisk, Uber. Can we talk about Uber for a little bit right now? So, past 1 year, they're up in the green, 20%. Trading multiple, forward trading multiple is a 24. Past 5 years, 53%. Year to date, negative 1%. Fundamentally and financially, this is a company that's just crushing it, right? But they're in a pickle, right? Because if you zoom out past 1 year, they did reach about $101 a share. Now they're $80. They're down by what, $20, $21? And that's because of all of the robo-taxi competition that's rolling out from Amazon, Tesla, Google. Again, big tech. Just like how I said in the payment processing landscape, I think big tech's going to be the winners. With Uber, I do think it's going to hurt them, but I feel like it's kind of overblown, right? And I think as of right now, low key, I think Uber is a little undervalued. Sorry. I almost triggered some people. Some people were about to pull open their keyboard and start typing stuff that are really, really mean. Had I said overvalued, but no. I think Uber is undervalued, but I cannot deny it. I think their future is absolutely disrupted because right now they're banking on people using their own cars to drive folks to go get groceries. But imagine this, in the future, eliminate the person from the car altogether. So there goes your 1099 employee, right? Your value add is gone. But when you think about it, the CapEx to roll out and implement robo-taxis everywhere to replace Uber, I don't know if I'm being too crazy here, but I feel like that's 10 to 15 years down the road. Because even when you think about Waymo, even when you think about ZooX, it's only in limited markets. It's not nationwide. It's not worldwide. And for that to take place, plus the cost behind it of like each car being 100 to 150 grand because of the LiDAR technology and everything, you almost have to ask yourself, is it really going to be better margins and better value add? Whereas you can have someone driving their crappy little Honda Civic. I don't know. I feel like Uber, for at least next 5 to 10 years, should thrive. But obviously, the whole robo-taxi conversation is not something that you can simply ignore. So, for me, I know in the intro, I was like, if you've been eyeballing to jump into them, this might be your opportunity. For me, I don't think it's an opportunity. I don't plan on going near them. Because when you buy a company, I want to know that their future looks bright. When I think about Uber, I can't say with confidence that their future looks bright. I think the next 3 to 5 years, they should be crushing it. Their scale, their network effects, they certainly have an economic moat in what they're doing and pulling off. But I think once robo-taxis become more widely available and it costs less for the consumer, I watched a YouTube video of someone, they compared prices of Uber versus Waymo, Uber versus ZooX. The robo-taxis are about the same price now. In the past, the robo-taxis used to cost more, but as that value proposition, because think about it, as a consumer, you don't really care, right? You're just going to go with whoever costs less. And I don't think Uber can fight that battle and win, because they also have to pay overhead costs of their software developers, the R&D, but also their 1099 employees, right? They have more, operating costs to think about that I just cannot see them winning the battle against robo-taxis. Now, obviously, I think there's a world where they both can coexist, but a world in which Uber continues to lose market share year over year. Like, I think in suburbs and rural areas, Uber is going to win, because I don't think it's financially responsible to roll out Waymo in the middle of nowhere, Oklahoma, or North Dakota, or Wyoming, right? So I definitely think Uber has a place, but dude, I'm not bullish about it. I'm so sorry. Let's just move on. We have GSK, a pharmaceutical company that most people don't really know about. It's based in the UK. One of my really good friends from my MBA program, he joined as a product manager, and I think now he's like the director of marketing at GSK. Love them because he's such a good guy too, right? And then there's CME. We're going to be talking about them later this week. A stock analysis request by a viewer like you. I did all of the homework, and then I realized, dude, I'm going to have to alter and modify all the numbers because they're reporting their earnings this week. So I'm waiting for them to report their earnings on Wednesday. That way I can give you the final, and I guess better and more up-to-date outlook. We have Allstate. Speaking of which, not that good of a insurance company. I think compared to their peers, I think we said they were a C or a C+. Not exactly the best. Oh, can we talk about Qualcomm for half a second here? So Qualcomm, they used to supply most of the communication chips in our Samsungs and our iPhones, right? And for the longest time, zoom back, they used to crush. But in like 2021, 2022, 2023, iPhone decided to make all of their own chips in-house. I still think they make the Snapdragon chips for Samsungs. And I think at one point they used to make the chips for the Google Pixel, but now Google Pixel obviously makes their own chips as well. And so Qualcomm, I want to take a look at their revenue situation. It's probably highs and lows, right? And this is what I mean by when I say the semiconductor chip space tends to be cyclical with highs and lows. Qualcomm's a really good example of that. And so, because they're losing the whole cell phone chip battle, they've been pivoting into supplying chips for EVs and data center stuff. To be honest with you, I don't know if I feel bullish about them. The fact that they're losing their most important customers, the fact that there seems to be, insider sell-off happening leading up to their earnings. I can't say that wholeheartedly. We would have to look that up to see. But the fact that they're down, I mean, take a look at that, right? Business as usual. And then, oh, wow, the weeks leading up to their earnings, they go on a massive sell-off. I'm assuming there's some insider trading happening, like a hedge fund found out about this. Oh my gosh, we have to jump ship. I'm not too bullish about it. If you're bullish about Qualcomm, you got to let me know, please. And I think this is a really perfect time for me to talk about how, dude, I'm not sure what's going on, but for the past 6 days, dude, I've just been mentally exhausted. Do you know what I'm saying? That feeling of where the lights are on, physically you don't feel terrible, but my brain just feels drained. My brain feels drained, for a lack of better words. And I was going to film this video on Sunday night. That way we could talk about Monday and everything. But dude, I just had no energy left in the tank, especially with a baby. Because here's the thing, right? When you go to sleep at 10 p.m., 1 a.m., whatever, you expect to get 6, 7, 8 hours of sleep, right? Uninterrupted. Dude, with a young baby, oh my gosh, I feel like that's one thing I took for granted. It's the ability to just sleep through a night. And I'm certain that's not helping, right? But yeah, I've just been so freaking tired these days. But hopefully, maybe because it's winter. Here in Japan in winter, it's really gloomy. Snows a lot. I'm wondering if it's like a vitamin D thing, right? Or a magnesium thing. I don't know. I'll look into that after this video. There's also Crown Castle, which is a cell tower REIT that I used to be invested into about a year and a half ago. And I think they also sold off their fiber cable business segment. I sold out of them at 105, 106. And when it comes to Crown Castle, I'm just not bullish about them. At one point, I did believe in them. I definitely think the better alternative between Crown Castle and their twin American Tower is 100% American Tower. And obviously right now they're also deep into the red, but I guess not as severe because Crown Castle's 48%. Reason being is that there's a lot of headwinds that Crown Castle is dealing with that I just do not, about a year ago when I sold out of them, that I just did not feel confident about. Number one is the whole cell tower industry, when you think about it, when you make all of the modifications and CapEx to improve to 3G, what happened, right? You had to make the exact same improvements to go to LTE, 4G, and then to 5G, and now you're gonna have to do it to 6G. It's just so much money in order to make money where it just does not make sense to me, right? And they're also going through like this huge courtroom dispute. I forgot what the whole detail is. It's with like EchoStar contract payment issues. Crown Castle, I feel very bearish about, especially with their landscape and future being disrupted by satellite-based communication services like Starlink. Yeah, not feeling it. We have one of the best BDCs in ARC reporting. We have Everest Group. This is an insurance company that I would not go near. There's a lot of headwinds that they're dealing with, especially with the California fires. Yeah, their margins are just cooked. Dayforce, U-Haul, Ensign, Rexford. This is a REIT that I am invested into, and the investing thesis was really simple. Southern California, Los Angeles, it's home to one of the, I think it's top 10 world's biggest economical supply chain, logistics, geographic area. And the fact that they rent out warehouses to companies that operate there, bullish. What I'm not bullish about is the California tax treatment, in that companies are going to eventually want to migrate over to like Texas or Nevada. But then again, SoCal, they're also home to the Port of Los Angeles, and it borders the Pacific Ocean to our partners in Asia. So then again, maybe the companies won't move, because that would be like shooting themselves in the foot. Mueller Water Products, another really good BDC right there. I'm trying to see if there's anything that really stands out here, guys. Bluebird. And we're going to jump on over to the next day, because I don't really like looking at small cap, mid cap companies. Way too volatile. Thursday we have Amazon. Now for Amazon, the key metrics to be mindful of, it's going to be their AWS, which is the cloud division, the margin increasing year over year, but also their digital advertising revenue, because I think that's one of the big developments coming out of Amazon, and why my other holding, the Trade Desk, is suffering. Word on the street is that Amazon is Amazon's eating the Trade Desk's lunch. Reason being is that they're undercutting them. They're charging companies way less to run their advertising and marketing campaigns on Amazon so that they don't go to the Trade Desk. And Amazon is such a big company that they can afford to lose money to do that so that the Trade Desk dies. Am I happy about that? No, but it's Amazon, right? And that's the game, I guess, play-by-play that they've done for every industry. That's how they got rid of JCPenney's, Kohl's, and Bed Bath & Beyond, all the other retailers that died to Amazon. So it's not something that they're just pulling out of their butthole. They've been doing it for a while. And previously, I said that Amazon is the most undervalued out of the Mag 7. But guys, now I'm starting to think Amazon, because I think their fair value is around like 280, 300. I think that title belongs to Microsoft now. So out of the Mag 7, like I always say, right? They take turns outperforming one another. I think it's Microsoft's turn next. ConocoPhillips, we got another pharmaceutical right here. Bristol Myers Squibb, Cigna, Fortinet, cybersecurity. Got a data center REIT, Digital Realty, Thomas Reuters, Roblox. Can I just show you guys why I'm so freaking bullish about them? Take a look at the situation. Take a look at their revenue growth. $300 million in 2018. Past 12 months, $4.4 billion. And look at the growth rate of their revenue. Since 2022, it's only getting bigger and bigger. So I'm personally really bullish about them. Then again, they're not a profitable business enterprise, because as you take a look at their bottom line per share, they've never been profitable. So on an accounting basis, they're losing money in order to run the business. But as a litmus test, if you take a look at their cash flow statement, their free cash flow per share, they've been free cash flow positive since 2023. So it's not a cash burning dumpster fire. However, between Roblox and Minecraft, it's really hard to say. Because if you buy into Minecraft, you also get access to everything Microsoft offers, right? So it kind of gives you a hedge and a risk diversification, whereas with Roblox, it's all in Roblox. And I think according to the price to free cash flow ratio, they're trading multiples around a 40. So it's not a cheap company by all regards. Whereas Microsoft, their trading multiple is like a 24. So we got Hershey. I just sold out of them at like 200 a share or something like that. Kind of sad, because I really like Hershey. It's just my vision and how I feel about the food CPG landscape has just completely changed. And then the Australian company Atlassian, dude, they're getting cooked beyond belief. Is it actually Australian? I feel like it is, right? It's either them or Asana. But anyways, really good financial performance, but the whole narrative on Wall Street is that software companies are obsolete because of vibe coding and also Anthropic's Claude. I don't really buy into that hype. I do think certain software companies are going to be absolutely disrupted, but the fact that they're saying everybody in the software space is screwed, like Salesforce, Intuit, Adobe, it's like, I don't know, guys. Am I being crazy when I think it's overblown? Ralph Lauren. Anything else? Molina Healthcare. I guess there's a lot of health insurance companies reporting as well, because tomorrow there's also Centene on Friday. Paylocity. The cereal company Post. Anything else bullish? By the way, I skipped over Strategy, ticker symbol MSTR. It's not a company that I'm particularly interested in, but I want to see how the market reacts, because Bitcoin, Ethereum, all the crypto, dude, it's been selling off nonstop for the past like 2-3 weeks. So I would be interested in hearing on how Michael Saylor responds. And there's Coursera, which is kind of like it's like an online digital certification software company where you, instead of getting a college degree, you can just get a certification from them to get like your Lean Six Sigma, your whatever, right? And it's a company where their growth is just kind of modest, right? You would think it would be exploding, but the value proposition, I feel as if there's no differentiator between them and Harvard Business School or Stanford or MIT or another school just offering online certificates from their own campus, right? Online, by the way, you don't have to be a fully accepted student. So of course, Sarah, I think good idea, just not a fruitful and thriving type of environment for them. But I know during the pandemic, they were killing it at one point. Speaking of which, do you want me to... During the pandemic, when they IPO'd, they used to be, what is this? Freaking like $55 a share, $53. Now they're $6. Golly, that fall is, not gonna lie, that's pretty severe. But anyways, what else we got on Friday? So Friday, you got Toyota, you got Philip Morris, you got Ken View, which low-key, I'm trying to buy into them because of the Kimberly-Clark acquisition. I did my math. I uploaded the deep dive video about it like 3 months ago, maybe 4 months ago. As long as I buy into Kenview under like $15, it's like a 20-25% ROI for holding on to them for 1 year. Because once Kimberly-Clark buys them out, I would probably sell my Kimberly-Clark shares as well. So that would be even further profits. So definitely company that I want to buy, and so I'm hoping things are not so good on Friday. It used to be the consumer products division of Johnson & Johnson, so things like Band-Aid, Neosporin, what else? Nicorette to help you stop smoking. But I don't know if they're going to go on a massive sell-off. I hope they do so that I can buy in under $15, but we'll see. Carlyle Group, Centene, company that predominantly does Medicare and Medicaid in the state of California. I'm actually invested into them. I'm in the green by 50%, despite them going on a pretty steep sell-off the other day. So I bought into them right here, and they're now $42.80. I'm a pretty happy camper. I bought the health insurance dip. I kind of wish, deep down inside, I went with Centene instead of United Health, thinking about it. But it's okay. I did not sell out of my United Health, by the way. I'm still holding on. And with that said, dude, I am so freaking tired. So I think I'm going to call it right here. Yesterday was supposedly my rest day, but dude, it was so hectic. Because yesterday we took our baby to get her 100-day photo shoot, and that whole ordeal with the studio and everything, and then the consultant afterwards, the Japanese consultant afterwards, trying to upsell us on everything. It was like a 2.5 hour thing, right? And I'm exhausted. So having said that, I love you guys. Stay safe. Good luck in the stock market. I'm going to quickly edit this video, get it up on the YouTube, and I will talk to you guys really soon. All right? See ya.